think there's a misconception that
Mm.
I'm gonna blame social media, but I think there's a misconception that you get into real estate and you're gonna start driving around in a Lamborghini and that life is uh unicorns, butterflies, and roses. I think I think the biggest thing is there's
I
work
see.
behind it.
Yeah.
You have to get into this understanding that there's going to be a lot. You have to educate yourself, continuously educate yourself. Things continuously change, new laws come into fruition. Things that you have to I wouldn't, it's definitely not for the faint of heart, especially when you got to think when you're taking someone else's capital, someone else's livelihood, you have to be the proponent to protect it with everything.
Hi, Adam Gower here, founder of gowercrowd.com and host of this podcast YouTube show, The Allocator, a new way to finance real estate, which is focused on this new world of the capital allocator. However, I did learn that my guest today, Chris Borden of Rise Capital Investments, although he has done some work in the capital allocator model, it isn't his primary business, but he does share some insights about that model and what he does in real estate investing. His background is very interesting. He comes out of the corporate world, like really truly corporate world. He's CEO of what sounds like quite a major company for some years, and so he brings with him the experience and insights that he gleaned doing that when he was living in Hawaii before he moved to Utah to invest in real estate as a second career. If you want to know more about Chris, just go to the podcast page at gowercrowd.com. I'll include a link to his LinkedIn profile, actually, which is where I met him, as well as to Rise Capital Investments, his website. And while you're there, please subscribe to the Gower Crowd newsletter. It comes out once a week and covers all aspects of real estate investing, from capital raising to passive investing to tips and tactics about how to use LinkedIn to increase your network and how to use AI and all kinds of fun stuff, but all 100% related to commercial real estate investing from one perspective or another. All right, let's get on with it. Chris Borden, Rise Capital Investments, coming right up. Chris, enormous pleasure to meet you. Thank you so much. It's always a pleasure to meet somebody that one has met on LinkedIn. I follow you all the time. You are prolific writer and poster and commenter on LinkedIn. Thank you for commenting on my posts as well, occasionally. Let's get straight into it. I want to know what you do for a living. I know what you used to do, but what do you do for a living and how do you make your money? Start with that.
Oh, that is a definitely. Well, first off, Adam, thanks for having me on the show. Appreciate you reaching out and appreciate you the same with the comments on LinkedIn. It definitely helps. Um, that is definitely a loaded question, and it comes with a lot. I think the focus of it is kind of looking at the funds and raising capital or deploying capital. Like you said earlier, there's a myriad of different ways that you call it. But I actually do a bunch of different things, and truth be told, the bigger underlying focus for us is more of the philanthropy work. I do, and I don't think we talked about this at all, but my previous career, I was the CEO of a large multi-billion dollar grocery chain in Hawaii, well, Hawaii and California. And I retired from that. I moved away from Hawaii to Utah to uh, honestly be closer to our kids. And we were going to retire. My wife and I were just gonna buy a house somewhere in the woods and live happily ever after. We were super fortunate enough to stumble across someone who had large dreams of philanthropy work in Africa. He's from Africa. And we set goals together, like very large audacious goals to impact the lives of millions of people. And that sort of catapulted our investment journey. So the investment journey came by accident as well. We weren't even 100% sure exactly what we wanted to do on the real estate side of it, or even if we wanted to do anything real estate related. We went to a few different organizations here when we first got to Utah and met a few people, and one thing led to another. We started doing, well, hard. Let me take a step back. We actually bought a few houses, not understanding or knowing what to do. We bought a few houses, got some renters in there, quickly found out that we didn't necessarily like doing that. I think that's the journey for most new real estate investors. And along the journey, we met different people, networked with different organizations, and one thing led to the another, and we started lending out. Well, I started lending out my own personal capital to other fix and flip investors. And again, more one thing led to another. I think just personally, I have to go back and look, but I think we did roughly about 14 million in debt allocations, just me personally. And then we found out the power of, okay, if we want to really scale this, I had the dichotomy when I was lending of capital versus deals, the amount of deals that come in, and just trying to balance the two out. So I ended up meeting another gentleman. I think I met Bobby. I think he was
Sharma,
on
yeah.
your, yeah, I think he was on your podcast. I met a few other individuals. Edwin does the same thing in Florida, had some discussions, and then eventually partnered up with a few individuals here, and we started a fund as well where we're allocating primarily debt. I would say 80% of it is debt, but allocating debt and equity investments through our fund and our portfolio.
All right, so let's talk about that then. So, the show is about capital allocator, the industry, this new industry that's emerged. So I've had a look at your website and I can read between the lines, but why don't you explain exactly? It's not clear, actually, unless you know actually what you do. So why don't you explain it to me really simply as you possibly can, how you find sponsors, cut deals with them, and how you then bring investors into those deals. What's the process?
Okay, we don't do that, but we've done it in the past. So we do have, I mean, there's a lot of things. I think the biggest thing is you have to, I don't know if this is the right term, but the biggest thing that we do is we listen to our gut. And you look at the sponsor first and see what type of experience they have. There's a lot of things that you can look at. I mean, I'm very analytical, so I'll look at the financial the details behind the financial setup of the particular deal. We've done several. We've never brought it into our fund. Everything that we bring into our fund, we originate and we do ourselves. Again, primarily debt. So there's not much there. There's not much underwriting or nuances between debt. There are a few, but it's nowhere near as complicated as equity. And you're sitting in a different risk profile anyway, between the debt and the equity side of it. But the biggest thing we look at is we're looking at the sponsor, their track record, how long have they been in existence? Have they gone through multiple cycles? And kind of looking at it that way. And then we'll go in and we'll do a real deep dive on the financial, and then we'll pull up. We have like I don't know, like 70 or 80 different bullet points that we look at.
All right, so you said that you don't. So the model that I described to you was what I come to think of as the capital allocator model, which is where somebody cuts the deal, some kind of favorable terms with a sponsor, and then either shares the delta with investors or harvests it for themselves for their own compensation. And I think you said you don't do that, but then you started to describe a world perhaps that sounds similar. So what exactly is it
We've
that?
done it. We've done it before. We don't do it in our fund. I've
Right.
done
So
it.
so that was the point you made. You say we don't do it in the fund. So you've got a fund, and then outside of the fund, do you do that kind of capital allocating
We've
business?
done it. We've done it in the past through different JV channels, utilizing, and this is just primarily a small group of investors. We weren't raising capital for it. So again, not the fund model. This was a group of investors. So so there's an exemption on the investment club standpoint. So we went down that function, and we would vet sponsors to invest as a group, a collaborative group of us. So we're not out there soliciting money like you would typically see from the fund standpoint. So our fund is set up a 3C5 fund on the investment company side of things. So we're very limited to the fund to fund model or that capital allocation model that you mentioned, that we need to have direct ownership of the majority of the investments that go through our fund. And we primarily, like I said from before, we primarily concentrate on debt. We just kind of, again, looking at everyone's risk return profile is a little different. I'm on a little bit older side of the spectrum, so I have a slightly lower risk to return profile, which is why I kind of invested. I invest in equity, I invest in startups, I do venture capital as well. But the larger portion of my portfolio is invested in debt. So that's why we set up the fund that way. We invest, like my personal capital is almost in 90% of all of the deals that we transact through the fund. It's a way for me to, I mean, I'm gonna be honest, it was a bit selfish. It was a way for me to consistently get my capital working and help other people along the way.
And so you manage those debt. That's your business, is to lend, manage, communicate
Yep.
with the sponsor. I mean, you're 100% the sponsor in that case.
Yep. Yep.
And then and so you also, and so in the fund, you also raise, you look for outside investors as well. I mean, that's
Yes.
definitely the sense I get on LinkedIn
Yes. Yep.
from
Absolutely.
your group. So
Yep.
what kind of numbers are you talking about? I mean, you did 14 million, you said, on your own before you started doing this. So what kind of numbers are you talking about now in the debt fund? How much do you have outplaced, and how much is that from investors, outside investors?
All the outside investors, I want to say it was a tougher year. I want to say it's about 5 million. But the one thing about debt, and the one thing about the fund is the 5 million keeps rotating. So it's not like an equity deal. It's a little different, right? An equity deal comes in and goes out. The debt side, somebody puts in $1 million or $500,000 that can work on in perpetuity. So it's not as if it gets counted. So it's a good deal flow to capital ratio, if that makes sense.
And yes, and it's just basically a being debt. It's just a yield play. There's no equity.
Yes.
There's no
Yep.
upside.
There's
Strictly yield.
zero upside. Yeah.
And then, so how do you make money? You'll charge a borrower 12% and pay investors 10.
Yeah, the points pretty much just cover the overhead. The biggest way I make money, don't forget, I'm in every single deal that's out there. So I'm personally investing my own capital into the deals, and that's how I'm making money.
Oh, actually as an investor, as a
Yep.
passive investor, and you don't take preferential terms for
Nope.
yourself. It's exactly the
In
same.
fact, whatever we charge the borrower is what we give the investor. So the investors will get again, the biggest, and the partners that I have do the exact same thing. They're investing their own capital in all of the deals. Again, we do debt and equity. It's just primarily debt. It's structured to primarily debt.
And what kind of assets are you lending on these days? Give me like,
There's a myriad. I would say primarily fix and flip investors, but we've
okay.
done commercial. I've got a few commercial projects that we funded, storage, multifamily. And we only do first lien position. So it has to be a first lien position debt. And then again, I told you 5 million. So it's gonna be $1 million, $2 million loan at the cap, especially on the commercial side. It's typically lower on the residential. It's roughly about 500,000 on the residential side of things.
And what kind of loan to value? These are very small loans. So what kind of LTV?
Yeah, we're normally at about 65% loan to value.
Okay, I see. Interesting. So I definitely get a different sense of what you do on LinkedIn. So what are the kind of what are the tell me about equity then. What do you do on the equity side?
We got an RV park, some multifamily in San Antonio. That is in the fund. We have a bunch of other ones though. So we've done again through the JV structure. We have properties literally all over the place. In the fund, it's just the two that I mentioned. So
Just the two.
The RV park and the multifamily.
Oh, I see. Okay. Because when I go to your website, so I went to your website, it says you own 2,210 units, 126 of AUM, but it's like custom homes in one place, multifamily in Texas and in Florida.
We've done a bunch of different things. We've done that. So all of the partners have done it together as a group through the JV structure.
A JV structure, what does that mean exactly? Are you finding sponsors in those areas that you're JVing with, or this is you running the whole show?
Those are all sponsors that we're partnered with.
Those are sponsors.
Yes, that's
How
the
do
one I
you
mentioned before, where we've vetted out sponsors. It's just not through the fund.
got it? You keep mentioning not through the fund. I get that. So in terms of those deals that are on your website, though, the 2210 units owned, 126 of AUM. That's with third party sponsors, is it?
Yes,
Somebody else. And
yes.
what was your role in those?
They're all co-GPs. So we're the co-general partnership in those. We have there's different um, things that we do in each one of them. Some is marketing, some is investor relations. They're all a little different. They're all structured a little differently.
And how many co-GPs do these sponsors have?
Oh boy, I don't know. I mean, the new build is just us. So it depends. They're all a little different. Some of the larger ones, they're multiple. I don't know the exact number. I would say in excess of 10 for some of the larger deals. Um, and then maybe from 10 to, like I said, what the new construction in North Carolina, I believe are the only general partners in there.
Okay, but in the others, in those other multifamily deals, the one in Texas and one in Florida, there are multiple 10 or more general kind of these co-GPs, and
Yes.
each person brings capital. That's kind of how they get
Yes. Yep.
compensated, is it?
Exactly.
And how do you determine? And then so the how is the how? This is what I'm interested in, and I'm definitely interested in the other stuff as well. But I'm particularly interested in this allocator model. So how are the how does that work? Tell me about the economics of one of those deals, say the Texas one or Florida, whatever, it doesn't matter. How does that work in terms of the splits and who owns what and how much you get paid from that?
Well, they're all different too. I'm gonna be honest, they're all a little different. Um, some have some have acquisition fees, some don't. It depends on, I think a lot of it, well, one, it depends on there's duties that are assigned and contributed into each one of the deals. So there's a percentage allocation of, so normally how it's going to work is there's going to be a percentage of the LLC that owns the asset is going to be allocated towards the limited partners, which I believe we are also limited partners in every single one of the deals. I'd have to go back and double check it, but I'm pretty sure we are. So there's a percentage that gets allocated to the limited partners, which is normally the general investors that don't do anything. And then there's a percentage that's going to be allocated to the general partners. So let's say 80-20 split or a 90-10 split. Based off of that split that's done for the general partners, there'll be a further split allocation based off of, again, the duties that are assigned and the capital that was contributed.
Right. So let's say it's so you talk about the promote, basically the GP economics. So if the
Yes.
GP is going to get call it 20% down the line, then the other co-GPs split that 20%. But presumably
Yep.
the GP wants the lion's share. So how does that actually get split? Is that based on the amount of capital that you raise?
Capital and the amount of the duties that you're performing, yes. But you're right. The original sponsor that found the deal is typically going to take the lion's share of it. And sometimes, like I said, sometimes they take all of the acquisition fees, sometimes they don't. It's a little different depending on how the structure is, depending on the asset. I'm gonna be honest, it's also dependent on the qualifications of that particular sponsor. I mean, if a sponsor has been doing it for a very long time, they're going to be less apt to give away a lion's share of their amount for capital contribution contributed. They're going to be looking at, and that's one of the ways you can kind of tell too if they're a decent, good enough sponsor. But Yeah, typically it's just going to be a percentage of capital, the capital contributed, as well as the duties that you're assigned to continuously perform in the entity.
So how do you balance that then? So if you've got a sponsor who is, like what would be the minimum tenure that you'd want to invest with a sponsor, for example, in this kind of situation? How long should they have been in business, minimum?
Oh, we do have again, like I said, I'm analytical. So we actually do have scoring metrics that gives them scores depending on a whole bunch of different things. So we'll look at how long they've been in tenure, how many deals have gone full cycle, because it's not only the tenure, it's how many deals have gone full cycle, and off of that full cycle, what were the return profile, and based off of that, we'll actually give them a score. We're actually working on refining that and further developing that, but we give them a scoring model, and normally 10 years, like if it's less than 10 years, then they'll get negatively docked or dinged against it. But we'll give them, so it's not just looking at that. We look at a few different things, especially on the sponsor. Like I said, I think looking at the sponsor, they're the most important thing. They're the ones that are gonna, because there's cyclicality in the market. Things do happen. Like if somebody thinks there's nothing's gonna happen, they're wrong. So things do happen. So having a sponsor that is knowledgeable enough to weather through the intricacies of the market and the intricacies of changes within the market, right? Political changes, economic changes, social global economic changes, they'll all impact your investment.
So a less experienced sponsor, let's call them somebody with just 10 years of experience. Typically, what kind of splits will they be willing to give to their little pool of co-sponsors?
Yeah, I mean,
Co-GP sponsors, co-GPs,
unless
I should say.
again, newer to the investment space, take a lot of it with. I mean, everyone has to go educate themselves. I definitely wouldn't put a benchmark exactly on that. I don't know the exact numbers. I'd have to go back and look at the deals. We haven't done one. We haven't done one all last year. So there's no co-GP deal that we've done last year.
Hmm.
So I'd have to go back and look. But what I can tell you is that they'll normally be more open to give you a little bit larger split for the capital that comes in. Um, and it's again, I wouldn't use that. We don't use that as a metric to ding against the sponsor.
Hmm.
We're going to look at
No,
again.
I'm just curious about what those numbers look like. Is it?
Yeah, I'd have to go back and look, but I just in general they're going to give you. I mean, in general, if it's a bigger sponsor, you get maybe 1% to 2% of the GP ownership. Maybe a larger sponsor, you can get maybe up to 6% of the GP slice. And again, it's still dependent on the amount of capital that you brought in and the duties that you're going to perform within that entity.
Okay, I see. Um, okay, and so of the deals that you have done that you did do, when did you do those?
They
Those,
were all, I think all of them were done in 2022 and 2023.
how are they doing?
None of them are giving distributions.
Hmm.
So, I think that's the telltale sign of the market. So the deals that we have in our fund have been consistently giving distributions from day one. And that's why we get to be a little bit more picky too with the types of deals that we go into. None of the deals that we've entered in before are giving out, well, they haven't for all of 2024. I don't think I'd have to go back and look. I'm pretty sure we didn't get one distribution in 2024. Most of them are holding back funds to be able to weather the interest rates, right? They had the hike in interest rates. Most of them had adjustable rate debt. And when the debt adjusted, it impacted cash flow. So to preserve the deal, they're holding back on distributions.
And that's these 2,210 units that you have on your website. Is that
Yes.
that's it, those?
Yes.
So it's two deals, is it? It's just two deals, the
No,
Florida and the
no, we have five, I believe.
five. Okay. And those are all with third-party sponsors.
Yeah, they're all different third-party sponsors.
Okay. And those were the capital allocator model that
Yes.
you brought investors. So how much
Yes.
money did you bring to those in total from investors?
Oh, I'd have to look. Maybe
Approximately. I mean, not
maybe
exactly.
about 5 million. I'd have to go look though.
Okay. And that was what proportion of the total raise of all of those projects?
But
Again,
again, remember, we weren't raising capital. So we weren't soliciting capital out there. We had an investment club, which we still do. It's an
Ah,
investment club of people that were looking to allocate money to different deals. It's not like it's not again not the same model that maybe you're referring to, and you've had other people on your guests on.
mm,
It's again, it was the model for investment clubs. You have to go look it up.
okay.
There's a big organization out there that does something similar called
Mm,
Fractional. It's based off of just investment clubs where an aggregate of people come together, like-minded people wanting to get involved, and then they will go and invest in the particular deal or sponsor syndication. So we did that for, we're still doing it. We just don't actively we're not actively investing in those deals because we're concentrating on the fund, but it's still something that's available out there to anybody. So again, not raising capital, not soliciting capital. A group of us got together that deployed our capital into these deals.
So what do you think, where do you think you went wrong in those cases?
Um,
What are the lessons learned from
I
that
don't know if I don't
experience?
know if wrong is the way
Mm,
to state it because again, everyone knows. Well, no, okay, maybe this is not everyone knows, but real estate, such as markets, they're all cyclical. They go up, they go down. I don't necessarily look at, and you got to understand too. Like the first underlying thing I said was, I diversify my portfolio, right? I have debt, I have venture capital, just like kind of what you were talking about, seed
mm,
investing. I have debt, venture capital, equity. If my equity play is not performing, I have my debt side that's performing. So me personally have been absolutely fine through it. I'm weathering the storm. I have income coming in on the debt side of it. It's consistent income. I
mm,
don't have anything coming on the equity side of it, but so I see a lot of it where this painted picture of negativity in the commercial real estate space, where it's again, yes, it is a down cycle right now, which is
mm,
probably a good time to start acquiring properties. So we got to start looking a little bit harder at that.
mm.
But it's still going to eventually, over time, again, barring any type of global economic crisis, um, we're gonna see prices come back up. We're gonna see exits. We're gonna get return of capital. So I'm not overly worried about it, and I wouldn't say wrong. It's just a lot of it's timing. So I entered the market again. I started roughly about 3 years ago. I entered the market on the equity side of it, probably at the peak, right?
Right.
When it was still at the peak, which again, everyone knows. I mean, Warren Buffett said a lot of times that's
Mm,
really not the right way to invest. But as long as you consistently are investing, you should be able to mitigate any type of troughs in the cycle, and then you're going to start seeing upside. So I'm not overly worried about anything. I would say the things that I've learned is um, again, I would say diversify. I think diversification is a definite key to it. Do not have all your eggs in one basket. I hear too much of the negativity by people that had all of their eggs in one basket, and have lost a lot of money. There have been deals that have we've had an equity deal that has basically foreclosed on. So it does happen. And was it hard? Yeah, it was definitely hard, but was it the end of the world? No, because again, I'm diversified between all different types of assets, between debt and equity and venture capital. So
So
again,
what would you say, Chris, has been the hardest lesson you've learned in your now this
short career.
relatively recent foray into real estate?
Um, I would say understanding the people that you're investing with is paramount. Um, are they from I hear I luckily, tap on wood, this has never happened to us. I hear of a lot of sponsors that are having a harder time and then they just stop communicating, right? There's no communication going on. I definitely hear it through different channels. I would say create a relationship. And if you're going to invest with somebody, like I said, understanding who they are and their values is like super important. Are they going to be the ones that are there when it gets hard, or are they going to be the ones that kind of leave you ghosted, and don't reply to you at all? That's probably one of the biggest things, especially again, especially in this, everybody's communicating, everybody's having fun when the market's going up, right? When the market goes down is when you truly see the people that are in it for the long run and that are going to be there to help you grow. I mean, ultimately, at the end of the day, we're all here, especially as investors. We're bringing in investors in hopes that the investor, gets exactly what they want through their whatever wealth journey they have. So it's really kind of aligning yourself with that value and the value that the other person brings.
So you sometimes you do go out and seek investors. You're in a club, but for the debt fund, you seek investors. So what have you found, Chris, has been the most effective way of bringing new investors into your network?
Um, I think our largest investors came from local networking. We've got investors through LinkedIn. We Instagram is really hard. We get a ton of people coming in from Instagram that are not really, they're tire kickers. LinkedIn is probably one of the better platforms to use for someone who's going to actively invest. And outside of that, like networking at local country clubs. We got large investors coming in from country clubs or just one of our, so we run, I mentioned earlier, we run the Utah Real Estate Investors Association. And we've got several investors, larger investors from that network as well. But it's just networking, it's creating relationships and understanding the value there. It's definitely not a short term, it's more of a long term. I have to create a relationship and I want to create a relationship with these individuals and help them on their journey. And that's probably been the most successful.
For somebody wanting to do what you do, what kind of characteristics should they have? What makes a successful? I know you're not a capital allocator. You've done a little bit, but in the club, it's basically what you do. What makes somebody who does that successful, do you think?
I think there's a misconception. I'm not 100%. I think there's a misconception that
Mm.
I'm gonna blame social media, but I think there's a misconception that you get into real estate and you're gonna start driving around in a Lamborghini and that life is uh unicorns, butterflies, and roses. I think I think the biggest thing is there's
I
work
see.
behind it.
Yeah.
You have to get into this understanding that there's going to be a lot. You have to educate yourself, continuously educate yourself. Things continuously change, new laws come into fruition. Things that you have to, I wouldn't, it's definitely not for the faint of heart, especially when you got to think when you're taking someone else's capital, someone else's livelihood, you have to be the proponent to protect it with everything. There's I would say a certain amount of um gut and grit that you need to have to be able to understand that no matter what, your number one priority is to protect investors' capital. And if you're not willing to do anything and everything it takes to do that, you're probably not in the right place.
All right, let me ask you a last question. Yeah, I'm kind of moving towards our end, and let's continue chatting as we started. But it's funny, actually, my last question, what is the biggest misconception? So I'm not going to ask that because you already answered it. So if you could go back in time, though, to when you retired, I guess, or sold out, not sure exactly what, from your corporate position, and knowing what you know now, what advice would you give yourself about getting into real estate?
I'm gonna be honest. I think I would go back even further and tell myself I should have gotten to it earlier.
Hmm.
I would say it was, I don't know. For me, it was pretty typical. Again, CEO of a large organization. I spent, I work ridiculous. I would work 80 to 100 hours a week, sometimes even more. Um, all of it was on the company, though. Me growing and scaling the company, not as much on myself. I mean, again, I got compensated well, so take it with a grain of salt. But I also worked really hard at it. Um, I would say the biggest thing I would go back and tell myself is to start earlier and start investing earlier. I did the normal traditional 70-30 portfolio, had it with Edward Jones. No negative on Edward Jones. I just had it there, which is where a
Hmm.
lot of executives I think have it. A lot of people, right? They just don't know any different.
Hmm.
I was getting typical returns. I think my 15-year return was somewhere around 6%. which I get double that just on my debt. I'm at very low risk on the debt side of things in what I'm doing today. So that's probably the biggest thing. I wish I would go back and be able to tell myself, hey, concentrate on this a little bit more. Look at real estate. There's a lot of opportunities in real estate. You just gotta be able to understand the nuances of it. And like I said, my whole thing, diversification, I think is key. And being able to diversify your funds, not having all your eggs in one basket, I think is probably the right route to go.
Chris Borden, Rise Capital Investments. What an enormous pleasure meeting. Oh my goodness. In person here on Zoom. Thank you for joining me today.
Thank you, Adam. It was such a pleasure. I loved it.
All right, that was Chris Borden, Rise Capital Investments. What a charming gentleman. He and I actually spent an additional hour chatting after that podcast. And Chris, I really enjoyed talking to you, and I do look forward to working with you in more detail in the coming months and years, all being well. And thank you for joining me actually today. It was a real pleasure to have you on as a guest. And thank you too, dear viewers, for joining us today. If you've not already done so, please go to GowerCrowd.com and subscribe to my weekly newsletter for everything that you need to know about raising capital in commercial real estate or investing in commercial real estate, with all kinds of cool LinkedIn and AI tips and tricks and tactics and all kinds of cool stuff thrown in for good measure, all totally focused on real estate investing. That's it for this week. Thank you again for joining me. Until next time, this is Adam Gower signing off.